You're watching Silver News Daily. Subscribe for more.
There is a new world out there which we are not involved with, and it is based on Chinese yuan that will become the principal currency replacing the dollar. And at some stage, it will be guaranteed by gold.
The global financial system is standing on a knife's edge, and almost no one sees what's coming. Everyone's watching gold. But silver? Silver is the ticking time bomb. As central banks hoard metals and bond markets buckle under unsustainable debt, something massive is unfolding in the shadows. China has made its move. They're not just stacking gold, they're preparing the yuan to go gold-backed, flipping the global monetary order upside down. And when confidence in the dollar crumbles, it's not just gold that'll explode, it's silver. Because while gold resets the system, silver detonates it. We've seen the signs before: supply shortages, COMEX manipulation, runaway premiums. But this time, the forces are bigger, louder, and more dangerous. The entire market is coiled, tighter than it's ever been. And when this pressure breaks, silver won't climb slowly. It will erupt violently. So how does a precious metal sitting at $36 today leap toward $1,000 in a matter of months? Stick around, because once you understand what's really happening, you'll never look at silver the same way again.
Yeah, I think, for a long time, China has had the view that the paper currencies of the West would eventually go to zero. This, if you like, stems from the Marxist universities who, in China, who basically condemned capitalism, reckoned that capitalism would destroy itself. And indeed, Marx himself saw capitalism as being, if you like, no more than a stepping stone to the final, his final nirvana, as it were, of a world which is controlled by the state, in effect, on behalf of the workers rather than by the bourgeoisie.
Well, of course, on behalf of the workers, always.
Absolutely. So, China started off with this, when Mao Zedong died, this thought, if you like, was behind the appointment of the People's Bank of China to act not only for all the foreign exchange transactions, along with the SAFE fund, which is sort of seen as a sovereign wealth fund, which is underneath the control of the People's Bank of China. But also in 1983, regulations were produced by the Communist Party appointing the People's Bank with sole control over the nation's gold and silver programs. And it was clear that with that big bear market that we had between 1980 and, this started in 1983, in effect, between then and the year 2000, 2002, there was a lot of gold coming out on the market. These were the conditions under which the People's Bank of China was able to accumulate substantial, undeclared quantities of gold bullion. By 2002, obviously the People's Bank of China and the Communist Party reckoned that they had got enough gold to secure their currency in the future. And so at that stage, they opened the Shanghai Gold Exchange and allowed ordinary Chinese citizens to accumulate gold. Until then, they'd been banned from owning it completely. Since then, Chinese nationals have taken delivery out of the vaults, the SGE's vaults, of around about 27,000 tons. Now, some of that would have probably gone back in as scrap, because anything which is resubmitted to the vaults, if you like, is scrapped and then recast. But on top of that, there is quite a lot of gold, which is actually owned by banks and also ETFs and other investment funds, which are stored within the Shanghai Gold Exchange's vaulting system. So, we're looking at very substantial quantities of gold. And I reckon that by 2002, I reckon the state had probably accumulated around about 20,000 tons of gold. And also bear in mind that
For years, China has been quietly orchestrating one of the most calculated monetary chess games the world has ever seen. While the West squabbles over budgets and bloated debt ceilings, Beijing has been relentlessly accumulating gold, officially and unofficially, stockpiling reserves not just in vaults, but in strategic infrastructure stretching from Shanghai to Switzerland. They've opened international gold vaults, deepened ties with BRICS partners, and now, with whispers growing louder by the day, they're preparing to unleash a yuan that's partially or fully backed by gold. This isn't economic speculation, it's monetary warfare. And the message is clear. The dollar's time as the global reserve is nearly up. Think about the implications. A gold-backed yuan would offer something the dollar hasn't had in decades: trust, tangibility, and a hard anchor in a world drowning in fiat. For countries tired of dollar dominance and U.S. sanctions, it's the ultimate off-ramp. Nations trading oil, rare earths, and tech could now bypass the dollar entirely, shifting the axis of global finance overnight. And what happens when trillions of dollars begin to lose relevance on the global stage? Capital flees to real assets. Gold soars, and silver, as always, follows with 10 times the ferocity. But here's the twist. This isn't just about metals, it's about power. By tying the yuan to gold, China isn't just backing its currency, they're backing their claim to global leadership. And in doing so, they're lighting the match on a system built entirely on paper promises.
I reckon the state had probably accumulated around about 20,000 tons of gold. And also bear in mind that they invested a lot of time and effort into both refining gold and also mining gold. And they quite rapidly became the largest gold mining nation in the world and have held that position for, 15 years now? 10, yeah, it must be about 15 years. So, and the other thing is, of course, we've seen gold go from the west to the east. I mean, this was, a story which that's 20 years old, that story now. So there's an awful lot of gold has gone into China, and not only that, but nothing comes out of China. I've spoken with directors of the Swiss refiners, asked if they ever see any Chinese refined bars, and the answer basically is no. There was a report of a few bars turning up, and it was thought that those were smuggled out. But, basically it's Hotel California for gold. So there's an awful lot of gold, both owned by the state and also owned, and not declared as reserves, incidentally, owned by the state and also owned by Chinese nationals. So how much it comes to, I really don't know. But you can see that China has a huge interest in the price of gold, if you like. And she has a huge disinterest in the dollar. So really what she's trying to do is she's trying to run, with Russia and Shanghai Cooperation Organization and BRICS, all these parties. She's sort of, if you like, dividing a world into a sort of schism between East and West. And the one thing she wants, if you like, is control over the settlement means for all the commodities she buys, the things that she imports and the things that she exports. And so she wants to do away with the dollar. And part of this is having control over gold markets. And that is why, it's one very good reason why anyway, that now that she, is de facto controls the physical gold market, she now wants to take away, if you like, the paper control, which is very, very much a dollar story. So that's one aspect of it. The other aspect of it, if we go back to what the Marxist universities taught, the Chinese students about how the capitalism would destroy itself. Well, obviously, if it destroys itself, the currencies get destroyed, particularly if they're not attached to gold. In other words, if they're just fiat currencies, they will go down the Swanee River as well as capitalism. Now, we can see the conditions whereby this is now going to happen to the dollar. Now, I think as far as the Chinese are concerned, they've expected this. This doesn't surprise them at all. But the election of President Trump, as far as the Chinese are concerned, is accelerating.
As China sets the stage for a new gold standard, the U.S. financial system is showing signs of fracture, and nowhere is that more evident than in its bond market. For decades, U.S. Treasury bonds were the safest asset on earth, the foundation of global finance. But now, foreign buyers are pulling back, major auctions are failing, and with over $36 trillion in national debt, the only thing holding the system together is faith, a faith that's rapidly eroding. Behind closed doors, America's creditors are questioning what once seemed unshakable. Why keep buying IOUs from a country whose debt-to-GDP ratio rivals banana republics? Why hold reserves in a currency that's being devalued year after year through endless deficits and unfunded promises? China isn't just backing its currency with gold. It's dumping treasuries and redirecting that capital into tangible assets. The message is clear. The dollar can no longer be trusted, and the world is adjusting accordingly. And here's where silver enters the picture. As confidence in government bonds crumbles, investors instinctively flee toward hard assets. Gold is the first stop. But history shows that when gold rises on monetary fear, silver doesn't just follow, it rockets. Silver becomes the people's hedge, the affordable lifeboat in a sinking ship. So when bonds finally break under the weight of debt and dysfunction, silver won't just react, it will explode.
The process of the death of the dollar, simply because he's a spendthrift. We've got that big, beautiful bill going through at the moment. Which will probably add, take that budget deficit up to something like 2.5–3 trillion. You've got an economy which, really, when all is said and done, is not behaving very well. It's probably in recession, and it is particularly in recession if you take out government spending. In other words, it's only government spending, unfunded government spending, which is actually giving the illusion of an economy which is growing. Take that out, and you've got a contracting economy. And it's been like that for a few years now. Now, this matters because of all the debt which has got to be funded. And you're going to see interest rates rise. And this is why at the long end of the US Treasury market, nobody can really raise anything out of it. I mean, the government has auctions, and they sort of continually disappoint or fail or whatever. So foreign investment, if you like, in dollars, they've got too many dollars. They don't want to have any more. If anything, they want to sell some. They want to reduce their exposure to the dollar. And it's not just China. Most of the countries, if you like, in the sort of Russia camp, see the dollar as a weaponized currency. They would rather not have, if you like, the risk that the dollar exposes them to. So you can see that the dollar is on a very slippery slope. And of course, this is why gold is rising. It's not so much gold rising, it's the dollar going down. But as far as China is concerned, they need to protect their own currency from a collapse of the dollar, which is becoming more imminent. And I think that informs their recent moves, which basically are they've said that they will open, or at least the Shanghai Gold Exchange, which is completely under the control, incidentally, of the People's Bank of China. They've said that they will open a vault in Hong Kong, and they have also said that they will open a vault in Saudi Arabia. Saudi Arabia, why? Because Saudi exports a lot of oil to China. Saudis want to be able to trade yuan for gold and gold for yuan. Quite obviously, because of their trade. And I think you may well see other ones, other vaults being opened. This is all part of the internationalization of the yuan. And then only, last week or 8 days ago or whatever, it was announced by the Shanghai Futures Exchange that they would open up the futures exchange in Shanghai to foreign participation. Now, a foreign bank can deal on the Shanghai Futures Exchange at the moment, but
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes. Real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active. A gold-backed yuan isn't just a challenge to the dollar. It's a wrecking ball aimed straight at the heart of the current global financial order. The moment China makes convertibility official, everything changes. Oil contracts, commodities, and even international loans begin shifting toward settlement in gold-backed yuan. Nations that have long resented the dollar's dominance, Russia, Iran, Brazil, now have an alternative, one tied not to political whim, but to a physical asset that's impossible to print. And here's the real danger. Once trust in the dollar is breached, it doesn't erode gradually. It collapses. The global financial system operates on momentum and belief. Remove either, and the unraveling is immediate. Trillions of dollars in foreign exchange reserves become hot potatoes. Nations scramble to convert paper into metal. And in that frenzied pivot, silver doesn't just benefit. It explodes in demand. Why? Because while central banks hoard gold, retail and institutional investors turn to silver. It's more accessible, more volatile, and historically far more explosive once capital floods into precious metals. In every currency crisis, silver lags at first, but when it runs, it leaves everything in its dust. A gold-backed yuan is the spark, but silver is the fuel waiting to ignite.
It has to do it through a Chinese entity. That is all going to go. So, and this is obviously not just gold and silver, it's also base metals. You know, there was the nickel problem, if you like, in London when a whole load of trades had to be cancelled by the London Metal Exchange. That was, a bit over a year ago now. So those, you know, they want to take control over all this, if you like, at least to their advantage. Now, I think that one of the points behind the internationalization, if you like, the mobilization of gold as part of a trading situation, if you like. I mean, trading not fixed at this stage to the yuan, but obviously trading alongside the yuan at some stage. When the dollar really does start collapsing, I think you will find the Chinese are in a position to immediately announce a fixed exchange rate between the yuan and gold in order to stop their own currency sliding along with the Western currencies led by the dollar. So I think this is all after President Trump's Liberation Day. I mean, bear in mind that the reaction from the Chinese was uncharacteristically quick. The first announcement that came out was that they were going to speed up the negotiations for a free trade agreement between China, Japan, and South Korea. And then this was rapidly followed by President Xi visiting some of the leading ASEAN nations, which are basically the other nations, if you like, in Asia, in Eastern Asia. I mean, I think I can't remember, he went to Myanmar, he went to Vietnam, he went to Malaysia rather, and I think he went to Thailand as well. So now this was quick. Now I'm fairly sure that the conversations that he was having was really about very quickly establishing a plan B, if you like, when America, started raising all these tariffs, this tit for tat tariff sort of thing. China needed to protect herself. She needed to secure her regional market, if you like, and that's what that was all about. And so this move on gold, I think, is in some senses an extension of that. And I'm sure that President Xi would have said to some of the leaders in these ASEAN nations, we're quite happy to sponsor a gold vault so that we can trade in yuan and we can trade in gold, whatever you like. I mean, this would be particularly one of the countries he went to was Vietnam. Now, the Vietnamese do use gold for ordinary settlement. I mean, you buy a house in Vietnam, you use gold. So, you can see the links, if you like. I may be joining the dots too much, but to my mind, it is actually quite clear that there is a new world out there which we are not involved with, and it is based on Chinese yuan that will become the principal currency replacing the dollar. And at some stage, it will be guaranteed by gold. And that, I think, is very, very important to understand.
Throughout history, whenever gold reclaims the spotlight during a monetary reset, silver doesn't just tag along. It ignites like a rocket. And that's exactly what's happening again. The gold-silver ratio, currently hovering near 100, is flashing one of the most extreme buy signals in decades. In simpler terms, it takes 100 ounces of silver to equal the price of 1 ounce of gold, a level that screams undervaluation and has only occurred during moments of peak opportunity. But this isn't just about ratios or charts. It's about what happens every time gold starts to surge. In 1980, when gold exploded past short of $800, silver catapulted from under $6 to nearly $50. In 2011, when gold broke miles $1,900, silver once again followed with a ferocity that stunned the markets. Now, with gold pressing new highs amid global instability, silver is still sleeping, but not for long, because silver isn't just a monetary metal, it's the pressure valve. When gold moves on fear and liquidity dries up, investors look for the next asset that hasn't yet priced in the chaos. And that's silver. The market knows this, traders know this, and history confirms it. So as confidence in fiat evaporates and gold leads the charge, silver is about to do what it always does: unleash a move so fast and violent that most will miss it until it's already gone.
Yeah, I think it's mainly a question of culture. In the UK, we had John Maynard Keynes, who had great influence in the UK Treasury and also, therefore, in other institutions such as the Bank of England. And the Bank of England was very much involved, for example, with other central banks like the Reserve Bank of India. I mean, I think the Bank of England is still consulted when it comes to appointing the governor of the Reserve Bank of England. So you can see that the sort of Keynesian influence has been extremely strong the whole way through, and it's something which I think has also, if you like, corrupted the Fed, if I can put it that way, and other European banks. I mean, they all talk to each other, and you've got this sort of, you've got the sort of top banks, and they sort of basically try and run things. And so they think the same way. And so you've got a very, very sort of Keynesian approach to it. But if, let us say, you're the Polish, very good example, the Polish central bank, you haven't been exposed to this, really, because it was only in 1989 that your country got independence. Until then, the zloty was just a rubbish currency. But things have actually changed quite a lot. And so they look at it rather differently. I mean, I remember central bankers, I can't remember, it was in the Czech Republic, I think it was one of the ones I knew. While the Czech Republic was having, the central bank was having one view, I was discovering that people within the central bank were having a completely different view. And you had Jens Wiedemann in the Bundesbank, who understood gold completely, and I think was instrumental in trying to get some of the gold back from the New York Fed. So, there are central bankers throughout the system who do actually understand the importance of gold. But where the new central banks are concerned, they haven't had this indoctrination to the same degree, this Keynesian or monetarist indoctrination. Call it the macroeconomic indoctrination. And so consequently, they see fiat currencies as being risky, which, if according to those of us in the West, I mean, the least risk is actually to own U.S. Treasuries. But and not only that, but I know that if you try and talk to economists about what a currency is, they see it as money, not credit. They don't actually understand. And I'm talking about economists who you and I would think should know better. I'm not talking about the Krugmans of this world. I'm not going to mention any names because I have come across a few of these guys who think that the dollar is money. It's replaced gold. It's as simple as that. They don't actually understand the difference between money and credit.
While the Western media debates inflation and interest rates, Russia is executing a strategy that could blow silver's supply-demand balance wide open. In a move largely ignored by mainstream coverage, Russia has committed over $500 million towards silver purchases between now and 2027. This isn't a speculative play. This is a strategic reserve buildup, and it's happening just as the silver market faces one of its tightest supply squeezes in modern history. Think about the implications. The silver market is tiny. barely over 1 billion ounces in total supply each year. When a nation-state starts acquiring hundreds of millions of dollars worth of physical silver, it doesn't just stress the market, it distorts it. Every ounce that disappears into national vaults is one less for industrial buyers, investors, and mints. And with supply already falling short of demand by over 100 million ounces annually, even a modest sovereign buy can cause a ripple effect that turns into a tidal wave. But Russia isn't acting in a vacuum. This is about de-dollarization, about building reserves and assets that can't be sanctioned or frozen. Gold gets the headlines, but silver is becoming a quiet reserve metal, liquid, industrial, and strategic. And as more governments wake up to silver's value, the already fragile supply chain faces a demand spike it simply can't meet. The result? A squeeze that doesn't just lift prices, it shatters the current pricing structure entirely.
Whereas, when I was a young man, I remember in the Middle East, the Maria Theresa dollars were in circulation. These were silver dollars, and they were circulating throughout the Middle East, used as money, particularly by the Bedouins. I'm only talking, about 50, 60 years ago. So, there is, if you like, a different world out there. There's a world out there that understands that metallic money is actually money without counterparty risk. And you can own a Maria Theresa dollar or, a gold sovereign or whatever it might be. And that, if you like, is yours. And there is no risk attached to it. And furthermore, nobody knows you've got it until you actually come and try and spend it somewhere. So there is this fundamental difference. Now, if you want basically what these guys are doing, they're not buying gold so much. They're getting the hell out of fiat currencies because they understand what a fiat currency is. We've forgotten. This is the important thing. And I think, if you go to the Bank of International Settlements, of course, they're appointed really. People like Carstensen, are appointed by, in effect, the major central banks. So we're looking at the Fed, the Bank of England, the Banque de France, obviously the Swiss National Bank, and various others. And there's a sort of consensus, and the consensus comes out maybe not completely anti-gold. Because the BIS does actually understand that gold has a major role, if you like, in financial markets. They argue a bit about how it should be categorized, and this is the Basel subcommittee. But they seem to have sort of vaguely agreed on that now and accepted that gold is an important asset, if you like. But the rest of the world, like the Russian central bank, the People's Bank of China, and so on, those banks, they're Johnny-come-latelys in this macroeconomic game, and they don't play it the same way. I think that's the best explanation I can give you.
All eyes are on COMEX, the epicenter of paper-silver trading, and what's brewing there could be the fuse that ignites the next financial shock. For years, COMEX has functioned like a pressure cooker, artificially suppressing silver prices through an avalanche of leveraged paper contracts. But now, the pressure is reaching its limit. Commercial traders have been piling on short positions, betting against silver's rise, even as physical demand hits all-time highs. That's not sustainable, and the cracks are starting to show. In December 2024 alone, over 40 million ounces of physical silver were delivered on COMEX, an all-time record. That's not just traders shuffling contracts, that's people demanding metal. Then came January, and with it, a nearly 50% premium on March 2025 futures compared to spot prices. That kind of divergence doesn't happen unless the market smells blood. And right now, COMEX is bleeding regrettability. Here's what makes this moment different. The disconnection between paper and physical silver is widening fast. When enough people demand delivery, and when big players start realizing that the physical silver simply isn't there to match the paper promises, short sellers will be forced to scramble. That's when a short squeeze begins. And in silver, short squeezes aren't gradual. They're nuclear. We've seen it before. In 1980, the Hunt brothers triggered a similar squeeze, and silver nearly hit $50. In today's market, with far tighter supply, far more global demand, and exponentially more leverage, the outcome could be far more explosive. If COMEX breaks, it's not just a market event, it's a global alarm bell. and silver will respond with a price move no one's prepared for.
Well, it rather depends, I think, on how the auctions are run. But, basically, if the auction, let's say, is disappointing in terms of demand and, the tail and all these sort of things, then that would be seen as a failure, if you like. I don't think there's any point in going into too much into that sort of, if you like, the technicals of it. But the problem really is there's a misunderstanding even in the markets about the price of credit, if you like. They don't seem to understand that we're in a situation where credit is it's increasingly risky. So, what does a foreigner do? I mean, does he sort of think that, 4.5% yield on a 10-year US Treasury is a good idea? Does that attractive to him? Well, I mean, what he's going to do is he's going to look at this US Treasury and think in terms of, what's the risk if I go and buy these damn things? And if the risk doesn't, isn't covered, if you like, by the reward, he's not going to buy them. So the signal that's being sent by bond market failures is that the rates are too low. The rates have got to rise. But then there is another problem, Dunnigan, and that is that as rates rise, for countries which are in a debt trap, and I'm looking at America here, amongst others, incidentally, it's not the only one, then higher rates basically make the situation even worse. So you've got a situation really where almost no interest rate is going to compensate an outsider for the risk of holding US Treasuries. You've got, at the long end, you've got institutions who do require actuarially longer maturities, pension funds, for example, insurance companies which write a certain type of business, that sort of thing. But really, for the vast bulk of foreign investors, I mean, they're taking a risk buying into a foreign currency, given that there is a mismatch between the currency they account in and the currency they've invested in. And they're looking at this from the point of view of, well, what's my risk on this? Am I going to make money on it or not? It's actually as simple as that. And, the answer is that if you've got a currency which is risky, and this risk is we're beginning to see more and more risk, with the big, beautiful bill and all the rest of it, then you kiss goodbye to the idea of lower interest rates. Well, I mean, the Fed can lower interest rates, but they're not going to sell any more bonds. Because all that will happen is that the bond yield curve will just go, stand on its head. I would say forget cuts in interest rates. I mean, I was reading a headline today that, some statistic came up which suggested that, the economy isn't growing or whatever, the normal sort of stuff. The bond yields eased on the theory that this means that there would be more than 2 cuts in interest rates this year. The Fed would be able to, come on. They just don't understand. They just don't understand risk. And this is actually quite frightening. The whole market is being wrongly priced. And there will be a moment of discovery, and it'll be extremely painful when it happens.
While paper traders gamble on contracts, the real story is unfolding in factories, assembly lines, and innovation labs across the globe. Silver isn't just a monetary metal, it's an industrial necessity. And in 2025, that necessity has turned into a frenzy. Last year alone, silver demand for industrial use hit a record 680.5 million ounces. This year, it's projected to exceed 700 million. Why? Because the world is going green, and silver is the one metal that makes it all possible. Solar panels are consuming more silver than ever before, with photovoltaic demand up 20% year over year. And this isn't a temporary spike. It's a structural shift. As nations ramp up renewable energy mandates, the need for high-efficiency solar cells, each of which requires silver, has exploded. There's no alternative, no cheaper substitute. Silver is the conductor of choice, and demand is accelerating faster than mines can keep up. Then there's the electric vehicle revolution. Every EV, from the cheapest compact to the most luxurious Tesla, relies on silver in its battery systems, wiring, and charging infrastructure. And with AI, 5G, and automation pushing even more electronic development, silver is embedded in nearly every cutting-edge technology being produced. This isn't theoretical. These are real, measurable, unstoppable demand curves. And they're colliding head-on with a stagnant supply chain that simply can't scale. Silver isn't just being bought, it's being consumed. And when the market finally realizes that the metal vanishing into solar farms and car chassis isn't coming back, the scramble for physical silver will erupt, not just from investors, but from manufacturers desperate to stay afloat.
Well, I mean, gold, one of the problems is that gold is not a regulated investment, so the regulators don't like it, full stop. That's one aspect. The other aspect is that if you're an insurance company, you've got two sources of income, basically. You've got the premiums that come in, and you've got the returns on your investments. And basically what you do is when the returns on the investments go down, you raise your premiums. When they go up, you can lower the premiums. That's a relationship. So, but always it's a return. It's an income return, if you like, on bonds or on dividends. If you've invested in a company that pays dividends, or if you like, the total return in the equity market. So, gold, if you like, doesn't really figure in any of this whatsoever. This is a pure currency thing. Banks aren't interested in holding gold either. I mean, because why? A bank is a dealer in credit, for goodness sake. It basically what it does is it creates loans out of thin air to yield X and takes in deposits at zero. Or if it has to balance its books, it might pay, X minus Y to the poor depositors. So, it's all dealing in credit. That's the whole thing. And when it comes to thinking that gold is volatile, actually what's happening is it's the currency underlying, which you're measuring it in, which is responsible for much of the volatility, not all the volatility, because the value of gold rises and falls depending what you measure it against. I mean, if you measure it against the price of, nickel or copper or something like that, obviously the price is going to rise and fall. But over very long periods of time, you'll find that a basket of metals, will retain its value. And before, I've shown charts, which actually was first put together by James Turk of West Texas Intermediate Oil from 1950 to today. At the times when it's gone up, I mean, it started off, I think it's something like $2.53 in 1950. It's been up to $140. It's been horribly volatile. It's currently 60 and change. And where is it in gold? In fact, the value of oil in gold has declined. It's down, I think it's down around about 40% from that 1950 price. So, that is actually a lot less volatile than measuring commodities, the things that we actually need in fiat currencies. And when you look at sort of wholesale price indices and all the rest of it, I mean, the story is exactly the same. It's currencies going down the whole time, not gold. Gold is, if you like, a representative of all those things together. I mean, it's the general price level is a concept. You can't actually sort of say that you can really measure it. But if you look at the purchasing power of any fiat currency, I mean, that's where the volatility is. It's just gone down and down and down and down. If you think going down on a smooth path isn't volatility, then I think we'd probably differ a little bit in our definitions.
Now let's talk about the other side of the equation, the supply. Because while demand for silver is setting new records, supply is doing the opposite. Global mine production is projected at just 844 million ounces this year, barely keeping pace with recycling and secondary sources to total around 1.05 billion ounces. And yet, demand is expected to exceed 1.117 billion. That's a deficit of over 117 million ounces, the fifth straight year of shortages. And here's the problem. There's no cavalry coming. Unlike gold, silver isn't mined on its own. Around 75% of global silver production comes as a byproduct of mining other metals like copper, lead, and zinc. That makes the silver supply uniquely inelastic. Even if prices surge, miners can't just crank up output. New silver-specific projects are virtually non-existent, and the ones that do exist face decade-long permitting delays and soaring costs. Ore grades are declining. Average break-even costs are rising, sitting around $26.86 per ounce. And with global inflation still elevated and energy prices surging, margins are thinning. If anything, we're on the edge of a contraction in supply, not an expansion. Now throw in Russia's $535 million silver buying spree and the possibility of more countries following suit. That's not just investment demand, that's sovereign accumulation draining a market that's already running empty. So what happens when a shrinking supply meets unstoppable industrial and investment demand? A shortage turns into a squeeze turns into panic, and that panic turns into a price spike the likes of which this market has never seen.
Well, Europe actually, I mean, the European central banks do have quite a lot of gold. I think that the statement about gold needs to be modified a bit, if you like. We're really looking at a geopolitical situation now, I think, rather than a monetary situation. It actually does worry me. The Europeans, now that President Trump, I think, has very sensibly backed off from this Ukrainian situation as a dead loss, if you like, as a failure of American policy, particularly American policy, because they've used NATO, if you like, as the bridge to try and drive Russia out of business through Ukraine, through a proxy war in Ukraine. The Europeans, who originally sort of seemed to show some understanding of where the Americans were in this, I'm talking about the Orange Revolution and all the rest of it going back to 2014, they now are supporting the Ukrainians and getting drawn into something which seems to me to be coming out of control. And we've had this thing of 18 months of planning by special forces, taking out all these nuclear capable aircraft, bombers, and all the rest of it. Now, I was fascinated to see an article in one of our main newspapers by a guy called, I think it was Tim Collins, who was a special forces guy, writing about this. Reading between the lines, I think it's quite possible that our MI6/SAS might have been involved in the planning of that. It could be that the CIA was involved in it. But if that's the case, I mean, looking at the statement that came out of the White House, was it yesterday, when this happened, the answer basically was that the Ukrainians had not given Trump any warning on this. Now, it's possible that he might have been given the warning not by them, so he could deny that, but by the CIA.
And the fire fueling this entire explosion? It's the global green energy revolution. Governments around the world aren't just encouraging renewable adoption, they're mandating it. Billions are being poured into solar, wind, and electric vehicle infrastructure, all under the banner of net zero goals. But here's what almost no one talks about. These green mandates come with a hidden cost, and that cost is silver. Every policy aimed at decarbonizing the grid, every subsidy for EVs, every target for solar installation directly increases silver consumption. We're not talking about optional use here. Silver's conductivity and durability make it irreplaceable in high-efficiency applications. There is no scalable substitute, especially not in time to meet the climate deadlines governments have imposed on themselves. Silver isn't just participating in the energy transition, it's becoming the bottleneck. Take solar, for example. Global capacity is expected to double by 2030, but the silver needed to produce that many panels simply doesn't exist at current output levels. The automotive sector tells a similar story. Each EV uses up to twice the silver of an internal combustion vehicle, and with production targets soaring, demand is about to outpace every forecast. These aren't market cycles. These are government-backed, policy-driven megatrends, and they're all hitting silver at once. When political mandates collide with resource constraints, price doesn't just rise. It explodes. And the market, already fragile and short on physical supply, is about to learn the hard way what happens when ideology meets geology.
But he sort of changed things around quite a bit for the CIA, and they would have been going against President Trump's orders if they'd pursued with that one. So I think we British might be involved with it. I'd be very worried about it actually, because we're now rearming, armoring. We're spending an awful lot of money, we're trying to get this through Parliament to spend 3% of our budget on defence and all the rest of it. The way in which this is being sold to the public is, we've got to defend ourselves from that nasty Mr. Putin. This is actually a situation which I think is intensely political and extremely concerning and could escalate out of control. So I am worried about this. And the Europeans, they're like headless chickens. I mean, without being steered by America, because NATO's basically been run by America, and we're just the yes men, if you like. I'm talking about Britain. Now you've got, NATO is just a shell into which is stepping Germany. We've got huge, great economic problems, which traditionally can be defrayed through war, taking the attention away from the domestic front. You've got France, which is a mess. They're also taking the same view. And you got Britain. With a Labour government which actually just hasn't got a clue about what they're doing, and they're flim-flamming this way, that way, and everything. I think it's a recipe for disaster. I really do. So I am actually quite worried about Europe without America, because there's not a lot I've got to say which is good about President Trump, but his recognition of the error, if you like, of trying to use Ukraine through a proxy war to attack Russia, that has failed, and he's trying to back off out of that. And this isn't our game at all. It really isn't. And I think our leaders are just making a huge, great mess about it. I really do.
As governments ramp up their green agendas and industrial demand drains physical supply, a new wave of investors, both retail and institutional, is quietly positioning ahead of the inevitable. For decades, silver has been the underdog of precious metals, overlooked and undervalued. But now, the smart money is circling. Hedge funds are increasing their allocations. Sovereign wealth funds are taking positions. And retail investors, armed with information and distrust of fiat, are stacking physical metal like never before. But this time, it's not just about stacking coins or trading ETFs. It's about front-running a system that's visibly breaking. Inflation is no longer transitory. U.S. debt is spiraling. Central banks are stuck between rate cuts and credibility. And the average investor is realizing that paper wealth can vanish in a flash, but physical silver doesn't. The psychology of this moment is crucial. As more people wake up to the fact that silver is both an industrial workhorse and a monetary hedge, demand is shifting from speculative to foundational. As silver isn't just a trade, it's becoming a core holding. And when that mindset takes root, price moves are no longer driven by momentum. They're driven by scarcity. We've already seen this begin. Dealers are experiencing shortages, premiums are rising, physical delivery times are stretching out, and this is with silver still under $40. So what happens when silver starts breaking resistance levels, when the headlines finally catch on, and when fear turns into FOMO? The answer is simple: a stampede. And in a market this small, that stampede becomes a price detonation.
I think it's extremely interesting points raised there. I'm not aware that the October date is definite, but certainly from Lagarde's comments, that is the direction in which she is going, yes. And in Spain, we've got a far-left government which is clamping down on virtually all spending, if you like. I can't remember the levels, but something like €3,000 has got to be reported, and it's just it's just getting crazy. I think that basically Europe is drifting into complete anarchy. I just don't see that the French people, for example, or the Spaniards will put up with this sort of thing. I think that, the French certainly have a history, if you like, of really rioting against their government. I think we're going to see that increase again. I am aware also that in Germany, we don't get this sort of opposition whereby, we oppose, but we respect the government, and therefore, while we oppose it, we don't go out and burn things and set fire to things and kill people and all the rest of it. Germany is actually a bit different on that. While I think that the AfD in Germany have got the right ideas in terms of direction and in terms of controlling immigration, which is a big, big issue in Germany now, I fear that, at the street level, you're going to get some pretty nasty things happening. So all in all, I think that these monetary changes, the CBDCs and all the rest of it, which actually is inflationary. It's another form of fiat currency. It's just extra inflation. I think that I think that Europe is in a huge, great mess, and of course, a number of countries are in deep debt traps. Italy, for example, debt to GDP of 140%. Spain is about 100. France is about 110. Something like that, I think. And in Britain, we're about 105. We're trying to control it. I suppose that's one thing that we are trying to do. But we're trying to control it basically by stifling the economy through higher taxes rather than cutting spending. And that actually, it's the problem that our Chancellor of the Exchequer has is actually all around Europe. It's also in America. No politician has the guts or, if you like, the mandate to cut public spending. So what do? They just tax us to hell and gone. And how does the economy go? The answer is that you cover it up because the purchasing power of the currency collapses or it goes down. You get more currency in circulation, and that's called an increase in GDP. It's fine as long as you can keep a lid on prices. I talked to John Williams about that.
As governments ramp up their green agendas and industrial demand drains physical supply, a new wave of investors, both retail and institutional, is quietly positioning ahead of the inevitable. For decades, silver has been the underdog of precious metals, overlooked and undervalued. But now, the smart money is circling. Hedge funds are increasing their allocations. Sovereign wealth funds are taking positions. And retail investors, armed with information and distrust of fiat, are stacking physical metal like never before. But this time, it's not just about stacking coins or trading ETFs. It's about front-running a system that's visibly breaking. Inflation is no longer transitory. U.S. debt is spiraling. Central banks are stuck between rate cuts and credibility. And the average investor is realizing that paper wealth can vanish in a flash, but physical silver doesn't. The psychology of this moment is crucial. As more people wake up to the fact that silver is both an industrial workhorse and a monetary hedge, demand is shifting from speculative to foundational. As silver isn't just a trade, it's becoming a core holding. And when that mindset takes root, price moves are no longer driven by momentum. They're driven by scarcity. We've already seen this begin. Dealers are experiencing shortages, premiums are rising, physical delivery times are stretching out, and this is with silver still under $40. So what happens when silver starts breaking resistance levels, when the headlines finally catch on, and when fear turns into FOMO? The answer is simple: a stampede. And in a market this small, that stampede becomes a price detonation.
CBDCs rolling out in America, it doesn't make any sense to me whatsoever. And I think also that the major banks, I think, would be against it. I guess that CBDCs, they can't be brought in by executive order or anything silly like that. I think that's a matter for Congress. And virtually every member of Congress is bankrolled by a bank somewhere along the line. I just don't see it. I don't see it passing muster. The Bank of England wrote a white paper on the introduction of CBDCs. And basically what they said, and this could well happen in America, is that if we have a CBDCs, then it's going to take quite a long time for this to come in, because you've got to sort of get the software working and all the rest of it. It's got to be absolutely foolproof. What the Bank of England would do, rather than, let us say, doing what the Bank of England, a Bank of International Settlements committee reckoned, and that is that we have direct accounts with the central bank as individuals and businesses. The Bank of England said, no, we won't do that. We will delegate that to the commercial banks. So the commercial banks basically will offer you two forms of credit, one of which is a CBDC and the other of which is a normal loan account, overdraft or deposit facility or whatever. So, in a sense, I don't know that I'd mind that terribly, if you like, from the point of view of someone who banks with a commercial bank. It's just a bit more choice. But as far as the government is concerned, I mean, if they start trying to use CBDCs as a means of stimulating this part of the economy or that part of the economy or whatever, I mean, it's going to be an absolute disaster.
Here's where everything starts to make sense. A $500 silver price might sound outrageous until you look at the setup through the lens of history, math, and inevitability. In 1980, silver spiked to nearly $50 during a much smaller crisis, with far less global debt, far lower industrial demand, and no competing reserve currency on the horizon. In 2011, with gold hitting record highs again, silver made its second parabolic run, again to nearly $4. And both times, silver wasn't even in a structural supply deficit. Now fast forward to today. The dollar is on the ropes. The U.S. debt load is unpayable. China is ready to dethrone the dollar with a gold-backed yuan. And silver? It's sitting below closer's $40, with a 5-year supply deficit, record industrial use, sovereign accumulation, and the highest gold-silver ratio in over a generation. This isn't a normal market. This is a dry forest, one spark away from an uncontrollable inferno. And when that spark comes, be it a failed treasury auction, a yuan convertibility announcement, or a COMEX delivery shortfall, silver's repricing won't be subtle. It will be violent. In a market this small, even a modest reallocation of capital, let alone panic buying, can send prices exponential. You won't get pullbacks. You'll get gaps. You won't get time to react. You'll only get the aftermath. A $500 silver price isn't a fantasy. It's a scenario rooted in history, driven by fundamentals and powered by forces that are already in motion. The only thing left is the trigger.
I think it's extremely interesting points raised there. I'm not aware that the October date is definite, but certainly from Lagarde's comments, that is the direction in which she is going, yes. And in Spain, we've got a far left government, which is clamping down on virtually all spending, if you like. I can't remember the levels, but something like 3,000 euros has got to be reported. And, I mean, it's just, it's just getting crazy. I mean, I think that basically Europe is drifting into complete anarchy. I just don't see that the French people, for example, or the Spaniards will put up with this sort of thing. I think that, the French certainly have a history, if you like, of really rioting against their government. I think we're going to see that increase again. I am aware also that in Germany, we don't get this sort of opposition whereby, we oppose, but we respect the government, and therefore, while we oppose it, we don't go out and burn things and set fire to things and kill people and all the rest of it. Germany is actually a bit different on that. While I think that the AfD in Germany have got the right ideas in terms of direction and in terms of controlling immigration, which is a big, big issue in Germany now, I fear that, at the street level, you're going to get some pretty nasty things happening. So all in all, I think that these monetary changes, the CBDCs and all the rest of it, which actually is inflationary. It's another form of fiat currency. It's just extra inflation. I think that I think that Europe is in a huge, great mess, and of course, a number of countries are in deep debt traps. Italy, for example, debt to GDP of 140%. Spain is about 100. France is about 110, something like that, I think. And in Britain, we're about 105. We're trying to control it. I suppose that's one thing that we are trying to do. But we're trying to control it basically by stifling the economy through higher taxes rather than cutting spending. And that actually, I mean, it's the problem that our Chancellor of the Exchequer has is actually all around Europe. It's also in America. No politician has the guts or, if you like, the mandate to cut public spending. So what do? They just tax us to hell and gone. And how does the economy go? I mean, well, the answer is that you cover it up because the purchasing power of the currency collapses or it goes down. You get more currency in circulation, and that's called an increase in GDP. It's fine as long as you can keep a lid on prices. I talked to John Williams about that.
So what lights the fuse? What singular event pushes silver from a steadily rising asset into an uncontrollable supernova? The truth is, it could be any number of breaking points. A failed U.S. bond auction that sends yields surging and the dollar into a tailspin. A sudden announcement from Beijing declaring yuan convertibility backed by gold. A COMEX shock where traders demand physical delivery that simply can't be met. Or even a geopolitical flashpoint. Taiwan, the Middle East, a cyber attack on financial infrastructure that sends shockwaves through global markets and triggers a rush into hard assets. But here's the thing. It doesn't take all of these. It only takes one. One crack in the system that reveals what insiders already suspect, that the monetary foundation holding up the global economy is nothing more than a confidence game. And when confidence breaks, it doesn't whisper. It screams. In that moment, gold will surge, but silver will detonate. Why? Because it's cheaper, more volatile, and more accessible. It becomes the people's gold, the go-to for those who missed the first move and now desperately want protection. The silver market is so small, so thinly traded relative to demand, that once the herd starts moving, the price action becomes uncontrollable. And we're not talking about a slow, orderly rise. We're talking about vertical candles, halted trading, soaring premiums, and physical shortages. The kind of move that rewrites financial history and leaves most on the sidelines, watching in disbelief as silver achieves what no one thought possible until it was too late.
CBDCs rolling out in America. It doesn't make any sense to me whatsoever. And I think also that the major banks, I think, would be against it. I guess that CBDCs, they can't be brought in by executive order or anything silly like that. I think that's a matter for Congress. And virtually every member of Congress is bankrolled by a bank somewhere along the line. I just don't see it. I don't see it passing muster. The Bank of England wrote a white paper on the introduction of CBDCs. And basically what they said, and this could well happen in America, is that if we have a CBDCs, then it's going to take quite a long time for this to come in because you've got to sort of get the software working and all the rest of it. It's got to be absolutely foolproof. What the Bank of England would do, rather than, let us say, doing what the Bank of England, a Bank of International Settlements committee reckoned, and that is that we have direct accounts with the central bank as individuals and businesses. The Bank of England said, no, we won't do that. We will delegate that to the commercial banks. So the commercial banks basically will offer you two forms of credit, one of which is a CBDC and the other of which is a normal loan account, overdraft or deposit facility or whatever. So, in a sense, I don't know that I'd mind that terribly, if you like, from the point of view of someone who banks with a commercial bank. It's just a bit more choice. But as far as the government is concerned, I mean, if they start trying to use CBDCs as a means of stimulating this part of the economy or that part of the economy or whatever, I mean, it's going to be an absolute disaster.
When the dust finally settles and the dominoes fall, silver won't just be another metal riding a bull wave. It'll be the symbol of a broken system and a new beginning. Every signal has been flashing red. A gold-backed yuan challenging the dollar's dominance, collapsing trust in U.S. debt, nations hoarding physical metal, industrial demand outpacing supply, and a paper trading system stretched to its limit. All of it points to one outcome, a silver price that doesn't just climb, but erupts. By the time mainstream investors catch on, it'll be too late. The smart money will already be out of fiat and deep into hard assets. Dealers will be out of stock, premiums will go vertical, and headlines will scream what you already knew, that silver's surge wasn't a fluke, it was inevitable. This isn't about speculation. It's about survival in a financial world that's shifting beneath our feet. So, if you've been watching silver from the sidelines, waiting for a sign, this is it. The playbook is written. The fuse is lit. And when silver finally moves, it won't knock. It'll break the door down. Make sure you're subscribed so you don't miss what comes next. And remember, this is not financial advice. Always speak to a professional before making any investment decisions.